So here we are again. Eventually, we managed to arrive at the worst of the final panel. So I'm delighted to give now the floor to the chair of the panel 4, which will focus on the adverse consequences of tax crime and corruption on sustainability, development, and human rights. The chair will be Alex Cobham. Alex is an economist who has researched tax and inequality at Oxford University and is currently serving as the chief executive of our partner institution, Tax Justice Network, which is an international organization challenging tax abuse and financial secrecy all over the world. So, Alex, the floor is yours.
Thank you, Costa, and it's a pleasure for both for me to chair this session, and for Tax Justice Network to be a partner on such an impressive research project. So thank you for that opportunity. I'm really delighted that we've got just an unbelievably strong panel to end the day today, and to discuss, as Costa says, these questions of in a sense, the ways in which tax crimes, particularly, but not only in the EU, and corruption that stem from those abuses of financial secrecy have knock-on effects in the EU and outside the EU, in terms ultimately of undermining human rights. You know, as they say, you can put human rights into law and into your constitution and anywhere else that you want them. But if states don't have the resources, those rights will never become effective. And you know, the work of the Tax Justice Network has in a good part been about starting to nail down the scale of the tax losses that are due to cross-border tax abuse that result from financial secrecy. So most recently, we estimate that cross-border tax abuse by multinational companies and by individuals hiding their assets and income streams offshore costs the world in total something like $483 billion a year. Let's round it up to $500 billion. But of course, although the larger losses in absolute terms fall in EU countries, the greatest losses in terms of the share of countries' budgets fall on lower income countries. So in some sense, almost everyone is a loser apart from a small number of conduit jurisdictions that are doing quite nicely at everyone else's expense. One of the issues explored, of course, in this research project. The panel we have today are magnificently positioned to talk about different aspects of this because they've worked on it, studied it, in some cases lived it from different angles, and coming to it with different insights. So let me introduce all of the panelists, and then I'll ask each of them to speak for around 10 minutes or so. So our first speaker is Eva Joly, who is a lawyer and a member of the Independent Commission for the Reform of International Corporate Taxation, or ICRICT. Of course, ICRICT is a high-level commission that's really brought these ideas, both of corporate tax and of financial secrecy, so they're also pushing for a global asset registry to end anonymous wealth, onto the international stage very effectively. Now, Eva was a member of the European Parliament before that, and in fact, vice chair of the Commission of Inquiry into Money Laundering, Tax Evasion and Fraud. So we couldn't have a better first speaker. Now, our second speaker is Professor Rita Calzada Pires, who will speak on the tax social contract and tax fraud double jeopardy. Now, Rita is an associate professor and vice president of the Pedagogical Council at Nova School of Law, with a degree and a PhD in law, graduated from the University of Lisbon. And is a particular focus on humanizing tax, and I think we'll hear something of what that means in this context when Rita speaks. Our third speaker is Will Fitzgibbon. Now, Will's a senior reporter at the International Consortium of Investigative Journalists, the ICIJ, which, of course, you'll all know are the organization that have coordinated and brought us over the last 10, almost more than 10 now, years, this set of crucial leaks of both corporate and individual tax behavior, let's say, in many cases tax abuse, including the LuxLeaks, the Panama Papers, the Pandora Papers, and others. And Will's also the African Middle East Partnership Coordinator for the ICIJ, so we're well plugged into exactly some of the places where the costs of tax abuse and other illicit financial flows are most powerfully felt. Finally, and I'm joining us shortly, we're delighted to have Benjamin Angel, who's the Director for Direct Taxation at the European Commission. Benjamin's held a variety of posts at the European Commission, but all of them around tax and finance, and has really led a great deal of the technical work done at the Commission on addressing these various threats of tax abuse as they affect EU members, but also wider in the rest of the world. So a policy perspective to finish the panel. So with those introductions made, let me ask Eva to speak first on these issues of tax abuse and their ultimate impact on human rights. Eva, thank you very much.
Thank you, Alex, and I'm very happy for this invitation and glad to speak to all of you. I think I have some good news to share with you, because I'm a practitioner rather than a thinker, and I'm a doer, maybe we could say. And last week, on the 16th of June, we did win a tax case, maybe you know that, over McDonald's. And that was the biggest fine ever given in a tax case in France. It was 1.2 billion euros. This was 700 million for tax and 500 in fine. And this was a complaint I filed in 2015 with a complaint from the union, the workers' union, because French companies have a mandatory institution. I think this is known in other countries. It's Workers' Council. And they are a legal person and they have money. They have a percentage of the salaries for themselves. And they have the right to be assisted by an expert to look into the accounts of the company. And this happened in 2015, that the CGT, the biggest union in France, was in majority in this council, and they were able for their subsidiary, what McDonald's West Parisien, it was only a small subsidiary, to establish that the royalties paid for the use of the mark was not the arm's length distance. I think this was very interesting because we did that before the last move of the BEPS project. We used the arm's length principle that has been in vigor for a long time, and we showed that the French restaurant paid much more royalties than the Americans one, twice actually. And this was the basis of our complaint. The investigation lasted for 7 years, and people were put under police arrest. There were searches in their private houses, in the offices, also in Luxembourg, in the Netherlands, and in the US. It was a huge cooperation, and it ended last week with this fine. They used a new process that we have now in France since 2016, which is from the Sapin 2, as we say, we have now, you can plead guilty in France, and you have a simpler, if you say, I do recognize the facts, and you pay the fine, and that's a way out of the criminal investigation. But you are not guilty, and you don't have it on your record. So this is a strange thing. We only have had the 20 cases like this all over since it entered into force in 2016. 10 of these are from Paris and important. I'm about writing a little article. I can share the main idea with you. It is that this time only the legal person were convicted or were part of the transaction, and not the individuals. My law firm, we looked up all the convictions in France for tax fraud for the last 2 years. This is the first time that no physical person is convicted. So this means that small companies, the COA are convicted, even to prison. But if you are stealing billions, well, you only pay a fine. I think this is remarkable. But still, it's good news, because they will be monitored for their taxes in the future, and they will play by the rules. Today's, I think, our common conviction is that the multinationals are not playing by the rules, and we need these convictions to make them change their way of behavior. So also at the end of May, 31st of May, I filed a complaint against General Electric along General Electric Energy Products France, which is also part of a big multinational. Along with the union, the same principle, we were able to show, I myself with a private expert, that they had artificially lowered their tax basis with 550 million euros for 4 years. And this is only one subsidiary of this company that has 14 in France. And they are telling people we are in deficit. We have 2 billion total in deficit in France. You see already one quarter of this is false, and I'm sure they are not in deficit at all, but they are preparing to close down. So this is very bad for the workers, and this case is important. And I think, and this is the good news, you see, we are doing this with the old tools, but you need the unions to understand that the new action for them is to look into the accounting, is to be able to say, but why do we pay a royalty for knowledge that are ours? Why do we pay so much money to so much royalties to use the brand, and so on? And this starting now to move on in France. And I have contact with several other multinationals, and I think within 1 or 2 years, many of them will be under investigation. So I think this is kind of good news. Maybe it's a little too long. I wanted to share experiences from my life rather than facts. And I think I worked in Kabul, for instance, for 3 years. We worked on the Kabul bank case. There is a film now that is projected by Al Jazeera this week. Here, in this very poor country, they were able to steal $100 million, and the money went to Dubai. And I think the interesting thing is Dubai, because we were able in the inquiry to establish who did the corruption, the bank account in Dubai, and we never ever got cooperation from Dubai. I'm running a network of prosecutors. I have done that since, I think, nearly 20 years now. We will meet in Lisboa next week. And here we have the Nigerian prosecutor from Lagos, and he tells that the rich Nigerian people, they are hiding their money in Dubai, and there is no cooperation whatsoever. And what is new, I think, also in the anti-corruption work, which is worthwhile mentioning, is that there are much less support now from the authorities for this fight. We are losing it. And we have an example in Italy, very important, with a corruption case of $1 billion in Nigeria, very well established, in my opinion, with a very experienced prosecutor, Fabio De Pasquale, and he has been attacked. He's been attacked by his own people, by other prosecutors for not doing some acts that they think he should have done, and he has been taken off the case. And this is totally unacceptable, but it shows that in Italy there is no will, no wish anymore to fight corruption, because what they want is the resources, even by paying. And I think this is very worrisome. This is very worrisome. Do you want me to talk a little bit more?
I might just ask one question, if I can, on
Yes.
on the McDonald's case.
Yes.
I mean, thinking back to the discussions earlier in the day on the role of the enablers, I wonder who the tax advisors to McDonald's were, and whether other companies are now stepping away quickly from them, and whether there's any suggestion that they might face charges, or if they just walk away with clean hands.
Yes, tax advisors. I mean, I really believe that as long as the COA and the financial director, the advisors, are not convicted, this will not end. And I know that the day when we get 3 years of imprisonment, and because we are in criminal matters, you have civil solidarity, they will be responsible for the eluded rights. And that means that it's a civil death. We had one case in France with a lawyer being convicted for assisting was a very famous designer, but this was overturned in the appeal court. So I have no example to give you where they have been convicted, but I believe that's the way to go. And unfortunately, this new system, which allows this huge penalty, it looks well. They do not go after the physical persons, after the advisors. So
I think this is a
global blind gate.
Yeah, it becomes a cost of business rather than a deterrent.
Exactly.
Look, we should come back in the Q&A, but I'm abusing my position as chair, so thank you, Eva. Professor Rita Calzada Perez, can I ask you to speak next, please? And with your experience both as an academic and, of course, as a tax arbitrator, I think you must have a fascinating perspective on these sorts of dynamics.
Yeah, thank you so much. Let me just share the presentation here. Everything's good? Yeah? So good afternoon. Thank you, Alex, and thank you, Costantino. Well, 10 minutes. It is complex to drive into a subject in depth, even more so when the participants are a vast group of such illustrious speakers. But let's try to present 10 minutes that give us food for thought. And my aim is to zoom out and to make a macro approach involving legal, economic, philosophical, sociological, and of course, political dynamics, all integrated in themselves, because taxation involves all these dynamics, and unfortunately, they many times are often forgotten. So straight to the point, what is my objective? To focus in the human dimension, and focusing, for me, the question that we need to try to answer is, how do tax fraud and tax crimes impact fiscal social contract? And I now launch some clues for analysis and reflection evidenced by the question. I would like to point out that these clues are the result of a research I've been carrying out in the field of, as Alex told, humanizing taxations, for as odd as it may seem. And it's a facet that deeply guides me, not only in the way I teach about taxes, how I interpret taxes, how I see taxes being applied, and how I demand from both the taxpayer and the state their action in the tax field. So let us just try to briefly insert some key ideas for our reflection, leading to the attempt of this answer: how do tax fraud and tax crimes impact fiscal social contract? 5 ideas. Idea number 1. In all of this discussion that we're having, that it's becoming very technical, I think trying to zoom out is very important to try to understand and to remember that it is necessary to revive the fact that tax, in a social rule of law, a state based on a social rule of law, tax is a democratic instrument integrated into a specific social contract. In other words, tax and all its dynamics are based on the contractual logic between the citizen and the state. And it is this contract, and from this contract, that emerges the basis of public financing in Western states. And it reveals high levels of taxation and long-lasting commitment based not only on the logic of ability to pay, but also on the logic of fiscal solidarity. Following this idea, it is very important to keep in mind that this is a contract that, precisely because it is a contract, it emphasizes the idea of shared responsibility. Hence, the title of my presentation used the expression double jeopardy. The fiscal social contract evidences a full relationship between the state and the taxpayer as a bionivocal relationship. That is, what one of the contracting parties does has deep implications on the way the other part acts and changes expectations and behaviors. No legal relationship is ever insignificant, as the sum of the various tax legal relationships is what generates the fiscal social contract of the society in which the taxpayer, the citizen, is inserted. It is said that individual behavior has particular and profound effects on relational model, for better or for worse. Therefore, it makes sense to say that non-compliance, specifically tax fraud by taxpayer, specifically and especially by large taxpayers due to their visibility and amounts implicated, amplifies the impact on other fiscal legal relations and consequently has impact on other taxpayers. And that impact exists, in my opinion, in 2 specific items. Firstly, because from a practical point of view, the decrease in tax revenue creates pressure on compliance, and specifically on compliant tax basis, and may even, as we have so many examples throughout the world, increase taxation on those compliant taxpayers. In other words, tax justice and tax equity are deeply affected. And we should not forget that the European social model generates a very high level of public expenditure supported essentially by tax revenues. So it comes the second aspect, because this chain of negative effects generated by non-compliance and specifically by tax fraud undermines tax trust disturbs the legitimacy of taxation, and consequently, this puts into question, it calls into question the foundations of the existing social contract, which is, as we know, the basis of the model of a collective organization. On a third aspect, revealing this, it shows the observation, the absorption of the impact of such undue behavior, not complying, the pressure on compliance costs with an increase in accessory tax obligations, as well as the urgency on aggressiveness for tax inspections, specifically in the intra-community environment, with the issue that is becoming hot and hotter, joint tax audits. One cannot neglect that these elements of efficiency and effectiveness press the perception of the compliant taxpayer and the way he trusts or not, legitimizes or not, the activity and the attitude of the tax administrations. So it leads also to a third idea. This fiscal social contract is a psychological one. This characterization gives an immediate notion of the importance of incentives to comply and disincentives to non-compliance. In other words, the tax system and tax regimes have to incorporate the psychological dynamic in the design, interpretation, monitoring, and evaluation of tax practice. Only as such will it be possible to achieve the ratio of the actions of the tax agents, be it the state which taxes and inspects, and the taxpayer who decides to comply or not to comply. Thus, fighting tax fraud and tax crimes implies understanding the cause of the behavior as a way to find effective measures capable of halting this undue practice. And in this domain, as I was trying to gather my thoughts in the morning to prepare this presentation, I thought that this trying to understand and understand the behavior and influence that behavior should have four main topics oriented or as guidance. The first one, the connection of the tax to the real and effective public financing needs, bringing the taxpayer closer to the primary raison d'être of taxes, to finance the state activity and ensure the common good. Second, the connection to the levels of taxation and tax effort borne by taxpayers, taking into account the old idea of the Laffer curve and the idea of limits for acceptance and compliance with tax. Third, the development of a culture of tax compliance and its association with tax ethics and tax education that somehow was being talked about in the previous sessions. These two aspects, ethics and education, are essential to reveal the dimension of fiscal solidarity. After all, fiscal solidarity is the essential basis for taxation and for awareness of the importance of paying taxes in accordance to one's ability to pay, or should we say it, fair share. And then the fourth, improving communication from the public authorities in the way they demonstrate the proper application of tax revenues so as to give credibility to the utilitarian relationship between those who pay and those who want to know what they pay for. And finalizing, almost finalizing, I'm going to the end, the fourth idea, that this social tax contract or fiscal contract, with all its above mentioned characterization and implication, also present under the spotlight the intergenerational dimensions of taxes. And here sustainability is a major outcome, because the model has been built on that understanding of counting with future generations to comply with social standards for everyday life. For that, and besides all that entanglements derived by the complex and profoundly relevant questions of inequity that make, of course, generations and the adaptation between generations of the social contract of utmost relevance. So first, that way to improve that acceptance between generations. First, either by providing space for young generations to be able to generate value and do that, have tax bases that can support the needs for tax revenues, and support and evolve younger generations to tax social contract, providing trust and ability for that tax legitimacy. And that comes to the importance, and I'm finalizing right now, that should be given to how tax professionals shape tax compliance. And again, ethics and tax education become very, very important. And as also has been shared on previous interventions, we need to first educate the future tax professionals as they can assert and provide an ethical aspect in advising taxpayers, but we also, for the now, as Eva was talking about, maybe we need to go, and Alex was claiming the opportunity for talking about, we need to start understanding if they should be more responsible for their actions within these attack to trust within these tax contract. Thank you.
Thank you. Five fascinating ideas. And yeah, it would be really interesting to think about, particularly internationally, if there are differences in the legal risks that tax professionals face and the ethical standards that they adhere to. But perhaps we get back into that. I must not be bad with time. So let me hand over to Will Fitzgibbon from the ICIJ, who has really explored a lot of stories of tax behaviour from the journalistic perspective, including with access to data that the rest of us have never seen and would really like to. Will, tell us something.
Thank you, Alex, and hello, everyone. Thank you to Costantino for the invitation. I am going to talk today a little bit about the lessons from investigative reporting in my experience and ICIJ's experience when it comes to reporting on tax and the role of Europe in particular when it comes to tax. And I think it may be helpful from the outset to make a point that will not surprise any of you in the room. Despite our best efforts, writing about and talking about taxation generally still does not make us the most interesting people at a dinner party. I'm thankful to say that we've seen a huge change within the media industry over the past 5 to 10 years, in part from projects like Panama Papers and Pandora Papers, in part because of groups like Tax Justice Network, who've really put the topic of taxation and fair taxation on the media agenda, in part due to the wonderful work of people like Eva and others and academics who routinely publish important case studies and meaty information that we can look at. But the fact of the matter remains that tax topics are seen within many newsrooms as the ugly family member or the ugly duckling of many newsrooms. And I think that's important to keep in mind as we talk about challenges to reporting on and to expanding our understanding of financial scandals and also the knock-on effects of tax crimes. At ICIJ, we struggle every year when we launch a big project in connecting the information that we have with stories and with anecdotes that we hope and think, often correctly, that will resonate with people. How do we turn 11 million documents from a financial services provider in Bermuda into a story that will be of interest to readers in the New York Times or the Guardian or Le Monde or the Indian Express or the Sri Lankan Times, for example? It's a constant struggle. And I think the way in which tax has often played a backseat to other financial issues, in particular bribery and corruption, is still with us. I'm sure we've all heard about the news this week or last week about Glencore, for example, in the United Kingdom, in the United States of America, and other countries where the company has finally announced it will plead guilty to a number of crimes, including bribery and corruption, and pay $1.5 billion in future fines. Glencore, of course, everyone in this room will know, has been subject to and dogged by accusations of tax avoidance and tax evasion for a long time. I myself, as part of the Paradise Papers investigation in 2017, wrote a story about how Burkina Faso, a small country in West Africa, was going after Glencore for tax avoidance, alleging that the company had used fictitious payments and shell companies in Bermuda in particular to avoid taxes, again, to one of Africa's poorest countries, a country that is racked by Islamic terrorism, insecurity, and poverty more general. So the two go hand in hand, I think, and I'd be interested in discussing more this topic, the extent to which kind of tax wrongdoing is often accompanied by other forms of non-tax related wrongdoing, such as bribery and corruption, for example. My experience and my instinct is to think that the two often go hand in hand, and that for various reasons, some cases are often written about more popularly in a corruption and bribery context than others. And I think, as I say, that that's important to keep in mind as my profession, the one of journalism, continues to grapple with how to use investigative reporting, or how investigative reporting can and should best address tax matters, tax crime, and how we connect those tax crimes to important issues like human rights. How do we make individuals sitting in their living room or sitting in their office understand that the McDonald's case, for example, that Eva talked about at the start of this session, is just important to them, their standard of living, and the future of their children and their grandchildren, as a quote unquote sexier case of drug trafficking might be, for example, or bribery and corruption. You know, of course, it's easier to and more enjoyable to watch on Netflix a corrupt Nigerian politician who stuffs his suitcase full of $100 bills from an oil giant, jumps on board a private jet, flies to the home of his London lawyer or his Swiss accountant or his PwC tax advisor, and goes on from there. That's certainly watchable television, and it works well as a narrative, much more so than describing a boardroom setting in which, you know, a Portuguese tax advisor offers Angolan billionaire Isabel dos Santos advice on how to set up a beer company in Angola. But the two are equally important, and I think that struggle will continue long after this conversation, as journalists continue to discuss investigative reporting in this context. I, for example, spent a lot of time a few years ago, again with the help of Tax Justice Network, reporting on double taxation agreements in Africa in particular, double taxation agreements signed in this case with Mauritius, but of course many of you will know them more from their European connections, Dutch double taxation agreements, for example, which have been hugely controversial, and a number of other ones. And to be perfectly honest, it was a hard sell journalistically. It was a hard sell to persuade reporters and editors to take on that story, to understand that something as quote unquote boring and dry as a DTA could be the subject of a story, let alone a series of investigative stories that explained and exposed why these DTAs were important and why reporters should write about them, and more importantly, why members of the public should report about them. And that barrier was raised at the level of small newsrooms, but also very large newsrooms. Now, large newsrooms who shall go unnamed, but whose mission is to report on business and tax matters, for example. So I always remember that struggle when I tell other reporters how excited I am when it comes to matters of tax evasion and tax avoidance, because I do believe that the tax crimes that we are able to report about as reporters, often thanks to huge leaked documents like the Pandora Papers or the Paradise Papers, but sometimes due to leaked tax assessments that are sent to us. I just a few weeks ago received a tax assessment from a whistleblower out of Kenya who sent me a document from the Kenyan Revenue Authority addressed to a company owned by a company tied to the Chinese government that allegedly had avoided more than $20 million in tax through fake companies in tax havens around the world. The Kenyan Revenue Authority alleged that Standard Chartered Bank in Mauritius was complicit in that tax offence. Standard Chartered Bank did not respond to my multiple requests for comment. But that story, for example, notwithstanding the fact that I had a leaked document from a sovereign nation's revenue authority, was of interest to nobody except myself and at ICOJ. It's one of the reasons I love writing for ICOJ, because we believe in these stories, but I could not find any Kenyan reporter who was interested in writing on that story with me, which once again was a reminder that we all in this room, but I as an individual reporter and ICOJ have a long way to go in continuing to make that case, that tax crimes do have a knock-on effect on human rights, both inside the European Union and outside the European Union. Thankfully from a reporting perspective, but unfortunately from a social justice point of view, in every investigation we do, including the most recent one, which was the Pandora Papers, Europe remains a problematic boil on the face of justice, be it Scotland, Switzerland, London, Latvia, Portugal, or the Netherlands. I believe that we will have more important stories to come relating to Europe's role as one of the financial hubs that are facilitating tax crimes and undermining human rights. I'm going to stop there, Alex. Thank you very much.
Thanks, Will. I'm minded to, I kind of want to make just one point on this, which is that, you know, the Tax Justice Network was set up in 2003. It took us till 2007 to get the first front page story about corporate tax abuse. And the headline was just how big companies dodge the tax man, which apart from the slightly unfortunate gendered implications, you know, today that's just dog bites man. You know, this isn't a news story. But at the time, getting that in the front of the Guardian was, you know, an enormous success. So we've come a long way, even if, you know, I share your impatience to be able to go further. But I think perhaps worth thinking that, you know, our reports now hit kind of billions of media reach around the world, which was unthinkable even 5 years ago. And that's, you know, in no small part because of the way that the ICIJ has opened up, you know, the reporting in these areas. But yes, there's more to do. There's always more to do. Now, making an unfortunate link, you've just called Europe a boil on the face of the world, or something on those lines. And I earlier suggested that Benjamin Angel, as Director of Direct Taxation at the European Commission, is the person responsible for solving all these problems. So, Benjamin, can you share with us your perspective on this? Can we fix the boil?
I'm not sure it is introduction I was hoping for, but I'll start nevertheless with this difficult setting. Thank you. Let me first say that I fully agree with William that we still have a lot of things to do within the European Union. We have done a lot already in the past. Notably, we have now an important set of directives ensuring an exchange of information between a member state, which is being extended on a near annual basis. We have already 7 directive administrative cooperation. We're about to have a 8 directive administrative cooperation this year, where we will try to extend the flow of exchange of information to areas which are relevant from a crime prevention point of view, like crypto assets, which, as we know, is a sector where there is today a lot of opacity, but also to other areas which are important for those who fight for tax fairness, like Alex, like an exchange of information on tax rulings on natural persons, for which today there is an absolute opacity, and that is a tool which is more used than commonly thought. The second area for which we have work in progress in the European Union is shell companies. I mean, William certainly bumped multiple times in his investigation on cascades of shell companies which are there just to either seek advantage or hide the ownership. So we have tabled last December a directive that aims at neutralizing the tax effect of shell companies within the European Union. The discussion is still ongoing. It's a complex discussion, as you can imagine, but there are good progress, and we hope that an agreement can be found before the end of the year. But we try also to have an action going beyond our border. And that is probably a little bit more unusual coming from the European Union. I will mention two things. One is a forthcoming initiative on a topic which has been quoted a number of times in this panel, which is enablers. It is very clear that enablers play a key role behind tax evasion. Each time there is a very complex dubious structure in BVI or Cayman, there is a smart guy who designs the structure. As long as we're not able to go after the smart guy, somehow we would fail to prevent the use of this structure. So what we are preparing is a directive that will cover all enablers. So we're not trying to regulate the profession of tax advisor. I guess it would be too difficult in the European Union because of the extreme variety of functions exercising this role, but that will set very clear behavioral rule whereby enablers cannot contribute to creating tax evasion or aggressive tax planning, we cover both, via the creation of structures in third country. So we will come with a robust definition and a set of rules and a set also of sanctions in the case where those rules are not respected, so as to make sure that we go effectively at the root of tax evasion. We have today a number of member states which are struggling enforcing rules on advisor. To take an example, there is a famous Colombian singer which has been prosecuted by the Spanish tax administration for tax evasion. The Spanish tax administration is able to go after the singer, but it is not able to go after the advisor of the singer. And I have some doubt on whether the singer had really a thorough personal knowledge of taxation, allowing her to have structures in Panama and in some other places. So this is really a very important area. We are working on it. We hope to have the proposal somewhere before the end of this year or beginning of next year. And we very much hope that member state will take this opportunity to make this very big step forward. The other instrument that we have is a bit more American in inspiration, which is the list of non-cooperative tax jurisdiction, the one that the journalists call usually the blacklist. But that is a relatively recent creation. It has been established only 5 years ago. What we are trying to do is not to impose unilaterally our rules. What we're trying to do is rather to incentivize very strongly third country to join the international standards in the field of taxation. So basically, among the criteria that we're using, you have taken a commitment to have an automatic exchange of information. You have to commit to do an exchange of information on request. You have to join the multilateral administrative convention on cooperating with other tax authority. You need to have substance requirement when you're a zero tax or low tax jurisdiction. You need to join BEPS. You need to have country by country report. Obviously, the criteria as they are not perfect, and we are very often criticized by the European Parliament and the NGOs for some flaws or some deficiencies here and there. But we should not underestimate, nevertheless, the progress that we have already accomplished thanks to these mechanics. We have, in 4 years, actually, 60 countries, 60, which have changed 140 tax regime, only because we have them. And I must say that is quite unusual for the European Union that we obtain so many changes in legislation of third countries. We have also pushed those countries to join the international bodies where tax cooperation takes place. And thanks directly to our action, we have, for instance, 27 countries which have joined the multilateral administrative cooperation. We have 13 countries which have introduced a substance requirement. It's work in progress. We have to make further step very clearly. We have already announced that new criteria are coming up. So for instance, we have to work on the effectiveness of the automatic exchange of information, which is an area where the Global Forum is starting also to make some ratings, which can be used then for our approach. We have to work even more important on beneficial ownership. I think it's clear that if we want to make progress worldwide on tracking tax evasion and aggressive tax practices, that is really the area where much more needs to be done. It is a difficult area where even within the OECD, some key players are sometimes reluctant to make progress towards, for instance, having one day an automatic exchange of information after information which is on the register, which would go a long way in helping the authorities to identify bad practices. But the last thing I would like to mention in this introduction is that whatever the effort that we put in ensuring this exchange of information, I think we need to put an equally big effort in making sure that the tax administration can work on the information they get. Because it's one thing to get tons of information from other member states or third country. It's another thing to have the right tool that allow you to make a smart use of it. Because the risk, notably with automatic exchange of information, is that you end up being flooded with information on literally millions of persons. So if you don't have the intelligent IT tools behind it, which allow you to detect where you should have a further look, where you should look at, where you should launch a tax audit, where you should launch further requests to the foreign countries, there is a big risk that you just miss some important information while it has been formally transmitted to you. It's a bit like those companies, you know, which are under investigation by the authorities, and when they have a request, and instead of sending 10 pagers, they park 3 trucks full of documentation, just hoping that the authorities will just be swallowed under the sheer volume of the documentation and unable to process it. So that is an important priority that we should not underestimate. Even within the European Union, we had a Court of Auditor report last year, which was mixed. That is, there are some areas where we're good, some areas where we're not so good. And it's important that tax administration in the EU and around the world in the future invest much more on this to be able to really pocket the benefit of the big effort which are being placed internationally in making sure that there is much more exchange of tax information to track the bad practices.
Yeah, thank you, Benjamin. I think you know, but I should say, you know, we strongly support the efforts to focus on shell companies and the enablers. And I think that point about the need for automation of quite granular analysis of information to support tax authorities is, you know, it's one we're working on with a number of tax authorities. And of course, the resources that tax authorities themselves have are key, not just the laws that are in place. But I need to ask you one question on this kind of extraterritorial issue, because I think this is a key one. You know, it's clear, as you say, that the EU has been very successful in generating extraterritorial legal changes. And I think the concern people have is that that's been more in lower income countries than it has in, for example, the United States, which continues to be at the top of our financial secrecy index and the least cooperative in a number of important areas, not least automatic information exchange. Is there any sense that perhaps the EU would see itself leading a move to the United Nations to a UN tax convention that the African finance ministers have now called for, that would see those extraterritorial obligations being negotiated in an inclusive way globally, rather than leaving the EU to think whether it's willing to try and police the US on its own, as it were. Sorry, you're muted.
Sorry, it's a difficult question. As regards the United States, obviously the situation is not perfect. One of the difficulties that we have with our list is that we can only take a state-wise approach. So we cannot start cutting the United States in small pieces. Globally, the US are fine, they are cooperative, but as we all know, there are some pockets of bad practices here and there. And so far, we are not in a position to really take those elements into account. Now, on whether we target more the meek than the mighty, I would disagree, actually. We have put a very high number of countries on our Annex 2, that is a list of countries where we ask to take commitment, fitting which there will be a blacklisting. And among the countries which have been at some point on our Annex 2, you have countries like, for instance, Australia or New Zealand. More recently, Israel has made it to the Annex 2. So we have actually all kinds of countries, sometimes African country, very often, unfortunately, Caribbean country, because it remains a problematic region. But we do also have much bigger one or much closer one politically. The instrument is not an instrument pushing anyone to adopt our rules. Our instrument is just here to push for joining the existing international framework, which de facto today, Alex, is rather constructed in the OECD than in the United Nations. I know that the Tax Justice Network and some other NGO are not happy with this situation. But we are taking the world as is, and de facto the place where tax rules are set is very much the OECD and its inclusive framework. It's not perfect, but for the inclusive framework, the participation is still pretty substantial. We have 141 countries. I guess that is not the full membership of the UN, but it is probably a sample broad enough to be able to claim that it is representative.
Well, we will continue to ask for the impossible, but I appreciate that. Thank you. Now, I must ask Costa, who has his hand raised, to make his question, please.
Thank you, Alex. I'm abusing now my principal investigator role like you've done before, because I have a question for Eva. So first of all, thank you for mentioning the McDonald's case and sharing with us your fascinating experience. I believe that in your presentation, you've touched the central core of this research project. During our research, we realized that to understand fully the interconnection between tax crime and corruption, we cannot rely on definition of corruption, which is just limited to the payment of a bribe to a tax official. We need a radical change of perspective, because the relationship between tax crime and corruption and complex social, economic, political, legal implications. Among them, the way in which corporations may use their immense power and wealth in order to adversely affect the political and regulatory landscape appears to be particularly problematic to us. So, Eva, I would be grateful if you could offer us, based on your experience, some additional thoughts in relation to the ways in which powerful corporations can affect the system, keep the gray area of tax avoidance broader than it should be, and use unethical lobbying, revolving door practices, or their own strategic economic relevance to obtain undue advantages that favor their private interests rather than the public one.
Well, as I told you, I do believe that we know that most multinational companies have very aggressive tax planning, and in my opinion, it's very often tax fraud. But what we see is that the prosecution authorities or the police, they are not starting investigations into multinational because it is too complicated for them. The multinationals are at home, they know how they have calculated their transfer pricing, and for the prosecutors to do it, it is very, very difficult. We have a very unfortunate example in Norway, where after 7 years in the Transocean case, everybody was relaxed and got huge dédommagement, got huge indemnities. So you must get inside in a way, and I think, in my opinion, it's through the unions that we can do it in the most efficient way, and maybe choose the countries where the legal systems allows you to oblige the prosecutor to start an investigation. That's the case in France, and that's the case in Italy and in Spain. That's not the case, I think, in England or in the Scandinavian countries, where the prosecutors, they decide by themselves. But as they have subsidiaries in these countries, this can be done from there. And I do believe that we only need 1 or 2 convictions where the COA and the financial officer are convicted, even to a short prison term. That would change the world. They would stop doing it because they do not agree to take risks in their liberty or in their fortune. So, and I think it's not, well, now that the BEPS rules are much more precise, really that's a good starting point. And as Mr. Anschel is here, I have not given up on the CCCTB for the European Union to take the lead and to have really unitary taxation of all the multinationals that do intervene in the European Union. I know that there was a lot of resistance because we were waiting for the OECD to come up with these rules. They have spent 7, 8, 9 years now to improve a system that cannot really be improved. I mean, where you are taxing the 3,000 subsidiaries of Veolia, well, there is no way. So that's the only way forward. And I think the OECD has admitted it, but we could take the lead. And also because we had Joe Biden, who wanted a minimum tax, that we have this minimum tax. Now they have started to carve it out, but we must resist so that we stick to the 15% as we can. We know which tremendous amount of money we are talking about, and we know how much money we need in the very difficult situation the world is in. So we must be able to tax the multinationals and the rich people. And we know the instruments, we know, and we could make the global asset register for the rich people. We are working on that in NICRITS along with other people. And we must start with the national registers, with everything that is already in place to make them interconnected and to enlarge them. And then from national basis, we must make it regional and to end up internationally, to be able to know who are the real owner of the assets, and to be able to shape good policies, because today we don't have the knowledge, we don't have enough knowledge. We know a lot, There are so many clever searchers, and I'm thinking about Gabriel Zuckman and what he did with Norwegian authorities, because they have very good statistics. And I think there were some 3,000 Norwegians caught in a leak in Switzerland. And they worked on these 3,000 people, and they were able to establish that in Norway, in average, people did hide 30% of their fortune. So that's probably the bottom, because Norwegians are rather careful people. So that gives an idea of what we are talking about. And these are reinforcing the inequalities. All this we know everything. Huh? But Europe has been terribly weak. And with the different president of the commissions, they didn't dare. They didn't dare for decades to do anything. Things have changed a little bit, but not that much. And maybe we could use Article 16 in the treaty to get around the unanimity rule, to get majority rule on this. But I know the European Union has a lot of other very important problems today. So maybe this has lost some of its urgency.
Tax justice is always urgent. Talking of which, I have, with traditional bad chairing, allowed us to run over, but I would like to take one question from the audience, if I have Costa's forbearance. So, but I think we need to turn off the recording for this.
Yes, let me turn off the recording 1 second, and I can give the floor to the audience member.
To Costa and the VIRTEU team for this platform, and for all the work in the research project. It's been a great contribution and will continue to be. And from our point of view, we're delighted to have been involved. So thank you.
Thank you very much, Alex. Thank you, Eva, Rita, Will, and Benjamin. And now.